right. We are going to take a look at Chapter 10, which is all about payroll. So let me just get this started for you here. So let's just take a look at a sample paycheck. So if you notice in a sample paycheck, there are all sorts of deductions. You'll see things like FICA, Medicare, Social Security, taxes. So there's federal tax, there's the Arizona tax. And then down here you have your gross pay, and then you have your net pay. So the gross pay is what you earn per paycheck before anything's taken out. So for example, this gross pay was $15.51, and then there's all this stuff that gets taken out. You've got your federal tax, you've got your state tax, you've got Social Security, Medicare, and then you finally get your net pay. So notice their net pay is $1,017.75. So net pay is what you actually take home with you. So notice there was like $500 there that seems to be missing because it was taken out for various reasons. Okay, so some key terms like we talked about here, gross and net. So gross pay is the amount before tax and deductions. Net pay is post-tax, and it's the amount you actually take home with you. So net pay is the same as your take-home pay. Some other key terms, we've got the amount of pay per hour worked. That's your hourly rate. So if you make $10 an hour, that's hourly rate. Overtime rate. So many of you may see overtime, especially if you work a retail job over the holidays. They might need you to work more hours. So it's anything over 40 hours, and typically there is a different rate for that. So a lot of times it's time and a half, which time and a half means it's 1.5 times your hourly rate. So if you normally make $10 an hour, then your overtime rate would be 10 plus half of that. So half of 10 is 5, so it'd be $15 an hour. But only for those hours that were over 40. Doesn't go back for all the other ones. It's just for the ones that were above 40, because 40 is a typical full-time employee. Your regular pay is just your hourly rate and overtime pay. Okay, so some different pay periods you may need to know. Weekly would be once a week. This is how often you could get paid. You don't see this typically every week, but if so, that would mean you would get paid 52 times a year, because there are 52 weeks in a year. Bi-weekly would be every 2 weeks, so that would be 26 times a year. Semi-monthly, so semi means half, so half the month you get paid twice throughout the month. And you might think that that should be the same as bi-weekly, but remember that bi-weekly, some months there will be 3 Fridays where you could get paid, because typically people get paid on Fridays, not always, but so it doesn't work out exactly the same. But semi-monthly, there are 12 months in a year. Twice a month would be 24 times. And then monthly would be once a month, so 12 times a year. All right, so Victoria earns $36,000 a year and is paid on a weekly basis. What is her gross pay per week? So all you have to do is take the $36,000 and divide it by the number of weeks in a year. So if you divide that by 52, you get, sorry, I just realized I need to pull my calculator up. Divided by 52. You get $692.31. So that's how much she gets paid per week. Now, this is her gross pay, so that means she probably isn't going to see that full $692 right now, because stuff will be taken out for taxes, Medicare, Social Security, etc. Okay. If she was paid on a semi-monthly basis, well, semi-monthly is 24 times a year. So instead of dividing by 52, we're going to divide by 24. Oops. And that's going to give us $1,500. So every paycheck would be about $1,500. Well, before taxes. Okay, so if John is earning $15,000 a year and paid weekly, you're going to take the $15,000 and divide it by the number of weeks. So you'll divide it by 52 to give you $288.46. If Logan earns $48,000 and he is paid bi-weekly, if you remember back on the other slide, bi-weekly is 26 times a year, so you divide that by 26 to give you this $1,846.15. Nicholas is $35,000 and he's paid semi-monthly, which is 24 times a year. So you basically just divide it by the number of times you're going to get paid. And that gives you $1,458.33. Okay, I'm not going to do that. Okay, so to find the gross pay per week based on hourly wages, first you'll take the number. So let's say that you work overtime. So if you work overtime, then you take the regular pay times 40 hours, because that's the max full time. And then to find the overtime pay, you're going to take your hourly rate and multiply it by about 1.5 unless your company is different. Some companies may say it's double for overtime. And sometimes they'll do this on special occasions too. So for example, if you work retail, maybe you get time and a half for working on Black Friday, because that's a crazy day in the stores, or on Christmas or Thanksgiving. So they'll do it for things other than just over 40 hours, but not every company. Okay, so once you've figured out the overtime rate, you'll multiply that by the number of hours that are over 40. And you just add those two numbers from steps 1 and 2 together. So Benjamin worked 45 hours last week. Okay, so more than overtime, because 40 is typical full-time employee. If his hourly rate is $10.50 an hour, find his total gross earnings. Okay, so first I'm going to do the 40 hours times his hourly rate. So 40 times $10.50. If you multiply those together, 40 times $10.50 is $420. So that's how much he gets paid for his normal 40 hours. Okay, then to find his time and a half rate, you're going to do $10.50 times 1.5. So $10.50 times 1.5 is 157.5. Oops, sorry. Forgot a decimal there. Is 15.75. Okay, that makes way more sense. So that means he's getting $15.75 an hour for every hour that's over 40 hours. So that's his overtime rate. So we'll take the $15.75 times the number of hours he worked over 40 hours. Well, he worked 45, so that's 5 hours over 40. So 5 of those hours he's going to be making $15.75. So we can multiply $15.75 times 5, and it's $78.75. So then he's making $420 for his normal 40 hours, $78.75 for the other 5 hours. If you just add those together, you get $498.75. So if Amber worked 48 hours, so the regular hourly rate is $6.50. So it's going to be $6.50 times 48. And then if you want to do this all in one equation, you're going to add $6.50 times 1.5 for time and a half. I'm sorry, this should be 40 hours. That is my deal today. Okay, so $6.50 times the 40 hours, and then $6.50 times 1.5 to give you your hourly rate, and that's going to get multiplied by the 8 hours. So if you want to do it all in one equation, you can. And then just plug that into your calculator, and you get $338. If Jared works 44 hours, you'll do the same process, $6.50 times 40, normal full-time employee, plus it's going to be $6.50 times 1.5 to give him his overtime rate times the additional 4 hours that he worked. So he should make less than Amber because she worked 48, he only worked 44. So it's $299. Okay, sometimes employers will try to incentivize their employees and motivate them to be more productive. So they may pay according to the quantity of acceptable items or jobs that they do, and those are called piecework rates. So a lot of times in production or manufacturing jobs, they'll do this. Similarly, often in the car business, if you're working on cars, it'll be the number of cars you can get done in the day. But the piecework rate is just the amount of pay for every acceptable item you've produced. There are two different kinds. There's straight piecework and then there's differential piece rate. Straight piecework rate is just the pay per piece is the same no matter how many items are produced. So you get, let's say, $10 for every piece that you produce. I know it's probably more than that, but just depending on what business you're in. Escalating or differential piece rate increases as you produce more items. So maybe for the first 10, they'll pay you $10 for each one. But then once you get above that, from 11 to 20, they'll give you $20 for each one. So that's increasing. So for example, Josue assembles microchip boards. He's paid on a differential piecework basis, so the price goes up. And here are the rates. So if he produces 1 to 100, he gets $1.32 for every board he produces. And then from 100 to 300, or 101 to 300, it goes up, and now he's making $1.42 for each one. And then anything above 300, he's going to make $1.58 per board. So he makes 317 boards. So that doesn't mean it's going to be 158 times 317, because the first 100 were only $1.32 per board. So it's going to be $1.32 times the first 100 plus $1.42 for the next 200. So there were 200 from 101 to 300. There are 200 items there. And then anything above that, so he had 17 more above 300. So that's going to be $1.58 times the additional 17. And then we can add those together. Got some fancy animation here for you. And it ends up being $442.86. Okay. I'm going to do that. All right, so sometimes jobs are based on commission. It's mostly sales jobs, also maybe real estate positions, but people who earn commission earn a percentage based on sales. So, for example, stockbrokers, loan officers, real estate agents, insurance sales agents, they get money based on how many jobs they do or how many sales they get. And there are two different ways this could happen. So straight commission is just your pay is only based on the number of sales. So a lot of real estate agents, they don't make any money unless they sell a home. Salary plus commission is kind of nice because you have a set amount of pay that you get, although that may be low. You at least know you have some money coming in, but then you also get money based on your sales. So my sister works in the apartment industry, and she makes her salary every day, but then for every apartment that she leases, she gets a bonus, and so that would be her commission. So she would get salary plus commission. So the commission rate is the percent used to calculate the commission. Quota. So sometimes there's a quota that you have to reach. You might have heard that before. It's the minimum amount of sales you have to reach before a commission. So maybe they say, let's use the apartment example. So you have to lease maybe 10 apartments, and then once you've hit your quota of 10, then anything above that you get commission. That's not true, but let's say that were the case. So that would be an example of a quota. Okay, so Adrian is a restaurant supply salesperson and receives 6% of his total sales as commission. His sales totaled $12,000 during a given week. Find his gross earnings. Okay, so this sounds like he's straight commission, so he just gets 6% of whatever he sells. Well, he sold $12,000, so you're just going to do the 12,000 times 6%. So make sure whenever you use percents, you convert them to decimals by moving the decimal over twice. So 0.06. If you multiply those together, you get $720. All right, so that's what he makes during that week. Okay, Amanda works for a cosmetics company and earns $200 a week in salary plus 30% commission. Okay, so this is not straight commission. This is salary plus commission. On all sales over 500. So this might be her quota then. She has to first get to 500 before she gets commission. She had sales of $1,250 last week. How much were her total earnings? All right, so she first gets $200 regardless. That's like her base salary. If she sells nothing else, she at least makes $200. Okay, the commission would be calculated at 30%, but only once she gets over 500. So the first 500 she doesn't get anything for. So if she sold $1,250, you want to see how much of that was over 500? We'll just subtract 500. So she had 750 sales that were above and beyond the $500. So that means she's going to get 30% of 750 in addition to her base salary. So I'm going to take 30% of 750. That would be 750 times points. It doesn't want to write on here. We'll write it up here. 750 times 0.3, and that gives us $225. So she's going to make this much from commission, and then her $200 because that's her base salary. If you add those together, she makes a total of $425. Okay, taxes. So to calculate federal withholding tax using the IRS tax tables, an employer has to know a few things. So your employer needs to know your filing status. So if you're single, married, or head of household, those are the three options. The number of withholding allowances, and we'll talk through that, that you claim. The type of pay period, so semi-monthly, bi-weekly, those sorts of things. And then your adjusted gross income. So some key terms. Income tax is the local, state, or federal tax paid on one's income. So it's your taxes, basically. Federal tax withholding is the amount that you have that's withheld from your paycheck that's paid to the federal government. So you'll have, some states don't have state tax, but most states do. So you could have federal tax withholding and state tax withholding. So if you've ever done your taxes before, you could get money back from federal and then also from state, or pay money, which is a sad alternative, but that happens often. Tax filing status just means, are you filing as married, single, head of household? That's what determines your tax rate. W-4 form. Okay, so there's probably two forms if you've done taxes before that you've heard of. W-4, W-2, and maybe you've heard of the 1040EZ. All right, the W-4 form is actually what you fill out when you go and get a job. So oftentimes once they bring you in for paperwork, you fill out a W-4, and that's the employer holds on to that to determine the amount of federal tax to withhold for you. So the W-2 is what you get in the mail later. W-4 is what you fill out when you get the job. Okay. So allowances. And kind of the rule of thumb for if you're trying to decide how many allowances to take out, the more allowances you claim, the less federal income tax your employer will withhold from your paycheck. So you have a bigger net pay or take-home pay. So there is an advantage and disadvantage to this. because if they don't hold a lot of income tax, then you're going to see a bigger paycheck. However, come tax time, if you didn't withhold enough, you're going to end up having to pay. So you kind of have to decide what you would rather have. So if you're not sure how many allowances to withhold, if you're claiming 0 allowances, that means they're going to withhold as much tax as they can. So that's good at tax time because that means that you'll most likely get a refund. But that means that you have a lower paycheck. If you're being claimed as a dependent on someone else's tax return, meaning your parents, maybe they pay for you still, they claim you as a dependent, then you would claim 0 allowances. So claiming 1 allowance is ideal if you're single with 1 job. And usually you get a refund when you file your taxes if you only claim 1 allowance. If you claim 2 allowances, that's either if there are 3 options basically. If you're married, you can do that, or if you're single. If you're single, claiming 2 allowances will get you close to your tax liability, but you may have to pay when you file your taxes. And if you're single and work more than 1 job, you may want to claim 2 allowances because you can claim 1 allowance at each job. Claiming 3 allowances, that's if you're married with 1 child, and then for every additional child you can claim an additional allowance. Okay, so if we look at the tax tables in your text, we want to find the amount of tax to be withheld. Let me see if I have that on here. Okay, so these should pop up as you're doing your homework assignment, and you can click to the tax tables, but we'll take a look at them as well. So Audra is single. She's paid semi-monthly, claiming 1 allowance and earning $1,700 per pay period. Okay, so if you look at this, she gets $1,700 per pay period. Okay, so this is for a single person paid semi-monthly, and they'll have single with all the different pay periods. So there are multiple forms. You could have a married person with all the multiple types of pay period as well. So this isn't the only one you'll see. There are multiple ones. But we're using this one because Audra was single and paid semi-monthly. So her income was $1,700 per pay period. So on the chart, we're going to go to at least, and we'll look for where 1,700 would fall. So notice 1,700 is here and here, but we want at least 1,700. This is but less than, right? So this is less than 1,700. So 1,699 will be okay, but not 1,700. So we're going to move to the next one that says at least 1,700 because that would include the 1,700. All right, and then up here, these are the number of withholding allowances. So Audra was withholding 1 allowance. So we'll go to 1, follow it down to the 1,700, $198. So that's the amount of tax that is going to be withheld from her paycheck. So that's where we got this. Okay, Brendan is married, so we can't use that chart. We're going to have to find the married weekly chart. So I happen to have that on here. How convenient. Married and weekly. So we need his wages. He's getting paid $585 per pay period with 4 allowances. Okay, so $585, we'll look on here. That is going to be between $585 and $590. And he's claiming 4 allowances, so we'll follow that down. And it looks like $11 is going to be withheld from his paycheck. So notice there's a big difference here, and mostly it's because of the number of allowances that they're claiming. So the more allowances, the less they're going to take out for taxes. Okay, so oftentimes you're eligible to claim an exemption, especially if you don't make enough or if you're a student. So I just wanted to comment on this. If you're wanting to know if you are able to, you can be eligible if you owed 0 taxes last year and you received a refund for the federal income tax that was withheld. You can also claim tax exemption from withholding if you believe you have no tax liability whatsoever for the current tax year. So maybe there were no taxes taken out, maybe you didn't have a job. Students aren't always exempt, so don't just assume that because you're a student you're exempt, especially if you have a job. An exemption might be possible for those who work temporarily during their summer break, because it's probably not that much, or maybe just part-time throughout the school year. But if you work full-time, you're probably going to have to pay taxes. So the total number of allowances you're claiming as a student would ideally be 0, especially if your parents can still claim you as a dependent on their taxes and you don't work. But if you're not a dependent, so maybe you're a little older or your parents aren't claiming you, and you're a working student, you could claim 2 allowances like a single tax filer would. Okay, instead of using tax tables, so what we just looked at were tax tables. Other companies may calculate the federal tax withholding using tax rates. So the employer deducts a tax-exempt amount based on the number of withholding allowances that you claim, and the resulting amount is called the percentage method income. Okay, so to use this method, so this should ideally result in about the same amount being withheld as using the tax tables, but it's just another method for calculating how much to withhold. So first you find the exempt per allowance amount from the withholding allowance table. Then you identify the amount exempt for one withholding allowance according to the type of pay period, so monthly, semi-monthly. You're going to multiply the number of withholding allowances claimed by the amount found in the previous step, and then subtract the exempt amount from the employee's adjusted gross income for the pay period. Okay, that's a lot of words, so let's take a look at how to do this. So Brian's bi-weekly gross earnings are $3,150. He is single, has no adjustments to income, and claims 2 withholding allowances on his W-4 form. So this is the table you would use for the percentage method. So notice we need the payroll period. His payroll period was bi-weekly, so we're going to use this one. And then one withholding allowance is $155.80. So that's for 1. He's claiming 2. So we're going to do $155.80 times 2, which will give us $311.60. So that's how much is being withheld from his paycheck. Now, if I wanted to know how much then he'll see in his check, you can then subtract that amount, the $311.60, from his gross income, from the $3,150, and you get, so basically $3,150 minus $311.60, and you get $2,838.40. So that's what his gross pay would be, or his net pay, sorry. Okay, so now you look at this table. Let me pull this up for us. It's in here. Sorry about that. Be in the charts instead. And I will make these available to you. So here's all the charts that I've been using in the PowerPoint. Okay, so there's more on the percentage method, so we're not totally done yet. So now you're going to look on here, and so Brian's biweekly gross earnings are $3,150. So we're going to find the appropriate line where his income falls. All right. So his income we had calculated to $2,838.40 in the last slide. So if you look on here, he is single. So we've got single, 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 and there's also some married ones. But we got weekly, bi-weekly, semi-monthly, and monthly. He's bi-weekly, so we're going to use this one. Here's married right here. Do you see that? So we're going to be using this right here. He makes 28, 38, 40. So that's right here between 1535 and 3592. So the amount of income tax to withhold is $199.40 plus 25% of excess over $1535. So he's definitely going to have to withhold $199.40. So that's part of it. But then he's also going to have to add 25% of any of his income that's above $1535. Well, above, so if he made 28, 38, 40, I'm going to subtract 1535 to figure out how much is above 1535. And that gives us $1,303.40. So that's the amount above 1535. So I need 25% of that. So you can multiply that by 25%, which would be by 0.25. And you get $325.85. So his tax that he's going to withhold is the $199.40 plus the 25%, which is $325.85. So if you add those together, you get $525.25. So that's the amount of tax to be paid there. So this is the percentage method of withholding, which is another way to calculate the tax withholding like we did in the tax tables from earlier. And this should pop up, this chart, if you need it. Okay, so let's pull this up again. Okay. So, Social Security and Medicare tax per paycheck. So, as we looked at earlier, you saw on that paycheck that Social Security is being set aside, Medicare is being set aside as well. So, find the amount of the earnings subject to be taxed, adjusted gross income less than or equal to $118,500. This changes every year. There's a different base that they base it on. So currently, when I did this slide, and it may have changed since then, they were capped at $110,100. So you're going to multiply the taxable amount by 6.2%, which if you move the decimal over twice is 0.062, to find the amount in Social Security taxes. And then the Medicare tax, you're going to multiply by 1.45%. So it's 6.2%, for 6.2% for Social Security taxes and 1.45% for Medicare taxes. And there's no cap on the income level. All right, so for example, let's say Christian's gross pay is $1,654. How much does he owe in Social Security and how much does he owe in Medicare? So all you have to do is take the get my pen ready again. Is take the 1654 to get the Social Security. I'm going to multiply by 0.062. That gives me $102.55. And then to figure out how much he owes in Medicare, it's 0.0145, which is $23.98. So you're definitely going to pay more in Social Security than in Medicare, just because the percentage is greater. Alrighty. A little update here. The maximum amount of wages in 2019 went up to $128,400. So anything above that is not subject to the 6.2%. Also, these went up as well. Okay, so one thing that you should know is that employers also pay 6.2% for Social Security and 1.45% for Medicare for each employee. So they're going to have to take out 6.2% for you, but then they're going to also have to pay that 6.2% for you. So employers really have to take out 12.4%. That's this times 2 for Social Security for the employees, and then this times 2, so 2.9% for Medicare, and then half of it they'll set aside. So if you are self-employed, that means you're taking out double for yourself, because you have to take it out as though you were the employee and as though you were the employer. So you're going to withhold double this, which is 12.4% for Social Security and 2.9% for Medicare if you're self-employed. So if you own your own business, don't just take out 6.2% for Social Security, take out 12.4% as the employer and the employee. Okay, so to find your net earnings per paycheck. So you're told that you're going to make a certain salary. Well, that's not actually what you're going to see when you take it home. So net earnings is your take-home pay. It's what you see on your paycheck. So you're going to find the gross pay. You're going to find any adjustments to income deductions, like amounts they take out. Maybe they take out insurance. Some companies will automatically deduct your health insurance for you, or retirement. Maybe you're part of the Arizona State Retirement System or something like that. Or you have like a 401k. And then you'll have to calculate the Social Security and Medicare tax. So you'll take those out of your paycheck, so you'll subtract those. Then you'll figure out how much the federal tax withholding is, and you can use either the tables or the percentage method that we talked about. And then if you have a state tax, you'll take that out. So these are all getting subtracted from the gross pay. And then any other deductions like insurance or union dues. For example, teachers have a teachers union that you can choose to be a part of if you would like. You're not required to because it's a right to work state here, but maybe in other states you are. And then you can add up all those deductions and subtract them from the amount of gross pay, or you can just subtract as you go. And then the resulting amount is called your take-home pay or net pay. Okay, so for example, Zachary's gross weekly earnings are $588. 4% of his gross earnings are deducted for his non-exempt retirement fund, and $27.48 is deducted for insurance. Find his net earnings if Richard is married and claims 3 withholding allowances. Okay, so let's start with his retirement fund. He's taking out 4% for his retirement fund. So he's going to have to take the 588 times 0.04. All right, so that's going to give us $23.52. Okay, the next thing, let's figure out his withholding tax. Okay, so he's married and claims 3 allowances. So I'm going to go back to that slide. We're going to use the table. Okay, so married. I just forgot what he had. Married, and he was weekly with 3 allowances. So let's make sure we can use this chart first. Married and weekly, perfect. 3 allowances. Okay, and then the amount that he made, I should really move this, was $588. Okay, so we go back to the chart. $588 is going to be between $580 and $590. He had 3 allowances, so it's $19. So that's how much tax, federal income tax, is going to be withheld from that particular paycheck. So we'll go back here. So $19. And then let's figure out Social Security. So remember that Social Security is 6.2%. So we're going to do his 588 times 0.062. That's going to give us $36.46. Okay, now let's figure out Medicare. That's 1.45%. So we're going to take his income times 0.0145. Okay, and then it said his insurance, if you look back at the last slide, his insurance, there was $27.48 taken out for insurance. So we'll take that out as well. So if we add all of these deductions together, that's what's being taken out of his paycheck, we get $114.99. So that's all being subtracted from his paycheck of $588 to give us $473.01. So that's what he's actually going to see on his paycheck, not the $588. Okay, so let's figure out the employer's total deposit for withholding tax. So remember, they have to set aside money for you and for themselves. So you'll find the total of withholding tax for all employees. So they have to set that aside, all that's going to be withheld. And then to find the Social Security and Medicare tax for the employees, they'll figure it out for each employee and then times 2, because they have the employee and the employer's portion to set aside. And they can add those for the total amount. So, for the employer's total deposit, first let's figure out Social Security. So here's how much is being held for Social Security for all, these are their employees. So they only have 4 employees, small business. So for Social Security, if you add all those together, that's $447.58. So that is the employees part. And then they also have to set that aside for that was the employees part, this is the employer's part. So they set that same aside amount. Or you can just multiply by 2. Okay, for the Medicare, if you add all these together, that's going to be $104.68. So they're going to set that aside. It's not going to let me write on here because it's too low. So we're going to have 2 of those. So that'll get multiplied by 2. So we had the 447 times 2, this times 2. And then they also need to set aside all the withholding. Now, this is the only thing that doesn't get multiplied by 2. You just add those together. The total withholding is $751.03. So they just set that aside in addition to double this and double that. So then you add all those things together. So I don't care about the net earnings in this case. I just care about the amount of withholding tax. So I'm going to set that aside. And the amount of Social Security, I'm going to double that and set it aside. And then the Medicare, I'm going to double that and set it aside as the employer. So if you add all those together, the total employer's deposit is $1,855.55. Okay. One other thing you may have heard of is SUTA and FUTA tax. What it stands for is it's basically unemployment tax. So there's the Federal Unemployment Tax Act and the State Unemployment Tax. So they are paid quarterly entirely by the employer. So they will not affect your paycheck. You won't see money taken out. And they will pay 5.4%. They'll pay, okay, so FUTA is currently 6.2% of the first $7,000 earned by an employee, minus any amount that they've already paid in SUTA. So it's capped at 6.2%. So if they didn't pay any money towards the SUDA tax, they'll pay all 6.2% to FUTA. However, if they paid SUDA tax, let's say the most you can pay is 5.4% to SUDA. The rest up to 6.2% is going to be taken out for FUTA. So if you subtract those, that's a difference of 8%. So 8% then would go towards FUTA. Let's say you only paid 5% for SUDA. That means you'd have to pay 1.2% to FUTA. So it's basically you're going to have to pay 6.2% regardless towards FUTA or SUDA or a combination of the two. So you start with SUDA, take that out, and then whatever's left over up to the 6.2%, you'll take out for FUTA. So the amount a company pays in their state unemployment tax depends on a company's unemployment history. And so like we said before, if the employer pays 5.4% in SUDA, they'll pay 8.8% in FUTA. Now, if the amount owed in FUTA in a given quarter is less than $500, no payment is made that quarter. You don't have to worry about it. It's just added onto the next quarter. So they don't bother with anything below $500. So let's say Samantha earns $40,000 a year. If the SUDA rate is 5.4%, calculate the amount of SUDA that Samantha's employer will pay on her behalf for the first quarter. So we just basically need 5.4% of 40,000. You don't have to break it up into quarters or anything. So times 0.054. And you get 378. So that's how much goes to SUDA. But remember, she had to pay 6.2% towards the combination of the two. So if you take 6.2 and subtract 5.4, we're left over with 0.8%. So that's 0.8%, which is 0.008 if you move the decimal over twice. That's going to get multiplied by 40,000 to give us the FUTA. And that gives us $56. So that's how much is paid towards SUDA, and that's how much is paid towards FUTA. All right, and that wraps up our Chapter 10 payroll. So here's hoping that your paycheck is big, and I hope you have a great day. If you have any questions, please feel free to email me.